Um, well, what can I say about Director Chopra? He is somebody that has been so consequential and so important to establishing regulatory clarity in our field. Whether we want to get some of that clarity or not, it's important that we do have regulatory and legal frameworks to establish our businesses and to expand innovation for consumers, for businesses, and for the economy. I'll make this brief. Um, Director Chopra has been doing this for a long time. He served as an FTC commissioner. He served as a consumer advocate. He's been the backbone of this system in one way or the other for many years now. I'm proud to call him a colleague, and I'm proud to call him an old friend. No, I cannot convince him to change the comment period. I'm trying. We know the CFPB doesn't care for holidays too much or enjoying them, but we're still here, and we're very excited to hear from some remarks from the director. The director will make some remarks, and then we'll do a brief question and answer. Only the questions that I'm asking, though, unfortunately, moderator's privilege. So with that said, Director Rohit Chopra, please join the stage. Thank you.
This mic, right? Yeah, okay. All right, well, thanks, Yana. Thanks all of you for being here today and inviting me to just stop by and close out your conference. So obviously, just take a look at the past few weeks about all the things here in Washington and the states we're thinking about: tech, digital, the future. Not just Washington, not just Brussels, all over the world, we're thinking about financial services and really what the promise of technology can hold. So obviously, a key priority for me and for the CFPB is to make sure that all of this technological progress is fair, transparent, competitive, and we really want to make sure that there's catalysts for competition that are not about seizing on some regulatory loophole, but actually about creating real technology that really helps people. A lot of people, maybe even people in this room, like to style themselves as Fintech, but really are just a website. We actually need technology that is really changing the game and really undoing some of the less competitive market structures, some of the structures that exploit people's data. So I wanted to briefly touch on two aspects of our proposed rule on personal financial data rights we published a few weeks ago, pursuant to Section 1033 of the Act. I've said this to you all before. We hope this rule will accelerate the shift to a more open and decentralized market structure for banking and financial services, and really giving consumers a greater ability to switch, to obtain more favorable rates, and to get great customer service. And those goals are never been more important, where we see that so many consumers are still getting near zero APY on their deposit rates, are experiencing way higher credit card rates than the increases in the Fed funds rate, and so much more. So first, our proposed rules would allow consumers, as you know, to share their data through secure, reliable, and standardized protocols. It would reduce the amount of work new entrants and technology companies need to do to clean, organize, and reconcile data received from hundreds of different sources, eliminate practices that data holders use to obstruct new entrants, and reduce the need for intermediaries. And importantly, as part of the proposed rules, we've proposed that firms that receive data through this secure sharing take steps to avoid misusing or abusing the sensitive personal financial data they receive. So just for a little bit of context, as part of what we did in this process, we looked very hard at what other jurisdictions around the world were doing. We looked very hard at the underlying incentives of what you could use this data for. And the truth is, it's not just about financial services. So companies receiving this data will not have a blank check to do whatever they want with it. They'll only be able to collect, use, and retain data that is necessary to provide the product or service that the consumer is in the market to obtain. We've proposed they can't use it for other purposes like selling the data or cross-selling other products. And in addition, they need to provide the consumer with a means to revoke your access that is easy to use as easy as the initial authorization. And if the consumer revokes access or fails to reauthorize access after 1 year, then consistent with the general standard I described, you will need to stop collecting new data and in the normal course, destroy the data that you've already collected. In short, the data is to be used for the consumer's purposes, not some other side project that you have. The company must benefit from the data only by serving those purposes. And these consumer protections and measures really are critical. And let me just share a little bit why. I think for open banking to accelerate and succeed in the US, it's really critical that we don't have a system where companies pretend to offer a loan or financial service as a pretext to collect all of our transaction data. You know how our system works. The CFPB is not licensing companies. In many cases, those who participate may themselves not even be licensed at the state level. So we will need to make sure that there is not some sort of underworld of companies pretextually collecting all of our transaction and other data and using it for a totally different purpose. We're actively thinking about ways to effectively enforce those rules that we ultimately finalize, and we're also working on ways to promote strong data protection enforcement in partnership with other federal and state regulators. So as Yana referenced, this is subject to comment, and I hope that you'll take a look at those data protection standards when you submit any input. The second aspect I want to touch on is standard setting. A major goal for me and the CFPB is to ensure that regulations are not so complex that they can't stand the test of time. Since I arrived 2 years ago, we've identified so many rule provisions transferred to the CFPB from the Federal Reserve Board and the Federal Trade Commission that honestly just seem designed to fit the needs of incumbents and dominant players rather than thinking about the small firms charting the future. So we're making big changes to avoid the big mistakes of the past. In the proposed rule, we're not looking to cement a particular technology or to micromanage how data sharing will work. Instead, the proposal outlines how market players can adhere to standards developed by standard-setting organizations. And the CFPB looked at a number of examples where those organizations help to shape open and competitive markets. Back in June, we invited those who are developing standards to share their plans with the CFPB, and we've been pleased to be in dialogue with many who are looking to develop standards. We don't see there being just one standard, but maybe multiple, although those standard-setting organizations obviously will have a lot to deal with when it comes to intellectual property governance so much. So I encourage people to take the time now to think about how standards will operate. Our proposed rule contemplates that the CFPB would formally recognize standards from those standard-setting organizations, and we will look to whether they have been created in a fair and open way. In other words, the standards should not be dictated by one set of market participants, but they should fairly represent all parts of the ecosystem. We have seen this time and time again in financial services where the rules are created by a dominant set of players, and those rules can be weaponized against new players who are entering. So we hope that fintech companies, chartered banks, credit unions, and others will really devote some energy to this. These are really two of the many issues, Yana, that we're soliciting comment on. I'm sure you all have talked in detail about other provisions of it, but I hope you really put some effort into both of those issues, because regardless of the legal framework, those two pieces I think are going to be core to trust and how ultimately open banking in the US evolves. So that's it. I think I'll turn it over to you now, Yana.
Sure, why don't you retire to our living area here, and we'll have a couple of questions. I know you don't have a ton of time, so we'll just kind of speak a little bit based upon your remarks. So one of the pieces that you concluded with, and I know that this has been, on the Bureau's radar, the question of big tech and big tech's dominance in the payments market. Can you speak a little bit further about, what the Bureau's doing to, address this dominance and address, make it, allowing the market to be more competitive for smaller players?
Yeah, so I think if we reflect on the last 25 years, and you really look at a core successful thesis of venture capital funds, investors, part of what has been a really good success for them has been to really take advantage of what is called a multi-sided market, a platform market, where you essentially control the playing field and that you can extract from both sides. And you use the network effects that you've created to essentially create huge barriers for switching at mass. So an open banking system is actually going to be crippled if there is one big player that really has so much power in the entire system. So you mentioned payments, but it really goes even beyond that. There's some real issues that all of the global financial regulators, privacy authorities, central banks, competition agencies are thinking about when it comes to big tech firms in payments. So we have done our own work and released our own study about the role, for example, of Apple and Google's regulations that they impose with respect to the use of near-field communications, the tap-to-pay feature in point-of-sale payments. So Apple, for example, does not allow fintech apps, bank apps, others to use the near-field communication device, and instead everything must be routed through Apple's proprietary Apple Pay. There's lots of ways in which large tech firms can leverage existing market power or network effects they've created, I think, to be able to get a big foothold in parts of financial services, which ultimately will make it tougher for smaller players to raise capital and challenge some of that. So payments is just one example. But I think when we reflect through history, one of the reasons the US has led in telecommunications, pharmaceuticals, the list goes on, it's because there has been a long tail of small firms that are able to enter and drive a lot of the innovation. We don't have what's called a national champions model. That's really kind of a Europe thing. And our recipe has been much more successful, but it doesn't work when you need a bunch of permission slips from a dominant player in order to get to market.
That's really helpful. And just staying along those lines, we know the Bureau's been quite busy with rulemaking proposals. How do I know? Because when they're busy, I get busy. So wanted to ask a little bit more, about the rulemaking that pertains to this conversation, the larger participant rulemaking that was announced last week. What more at this point can you say in terms of what the Bureau is looking at for this proposal?
Yeah, so just so everyone's clear, the CFPB already has enforcement authority over all these consumer payments players. So I think what we're trying to do is, as an alternative to enforcement, we're able to get more real-time look through supervisory examinations. Now, in many cases, those firms, Yana, may already be subject to supervision through another legal authority, but I think we are trying to establish this just as we've done with large credit bureaus and consumer reporting agencies, auto loan companies and servicers, remittance providers, large debt collectors. We want to make sure that we have that type of insight. So I do hope that this is going to be one way to make sure we have a level playing field. And we really understand how data is being harvested by payment apps and how it is being used. And I think ultimately we're seeing that privacy and data issues are going to continue to be a focus for us. It's not just what we've proposed last week. We're also contemplating how we might update rules under the Fair Credit Reporting Act to make sure that certain data brokers are really covered under the existing framework. So you may know, and many of you may even buy these data sets where you can purchase pretty detailed information about customer demographics, including, and this is very worrisome, older adults who may be suffering from cognitive impairment, teenagers who may be suffering from mental health issues. So there's all sorts of new ways in which companies are assembling data, and those may be consumer reports covered under the Fair Credit Reporting Act. And like you said earlier, we want to provide that clarity.
Really important, and just looking at in aggregate, the open banking pieces, Section 1033, and the upcoming proposals to FCRA. Our members are absolutely very engaged and looking forward to being able to share their points of view on the work that they're doing and the way that the rulemaking impacts them. So switching gears a little bit, another piece that's really important to many of the folks here, AFC companies and others. Artificial intelligence, the use of AI in a series of decisions. We know that a lot of the regulators and certainly members of Congress are looking in this direction a little bit more in terms of ways to make sure we understand the processes of how this works. Can you speak a little bit about the Bureau's next thoughts on the next steps on addressing AI, and in particular in the housing appraisals area, but other examples as well?
Sure. So I encourage really everyone in our industry to sometimes level set with people about terms like algorithms, artificial intelligence. The truth is here in the US, we've been using advanced computational methods for decades. Many people might even describe a FICO score, like an algorithm or AI. So to me, I really like for us to break it down into the parts of the credit life cycle and how it might apply. So, we've thought quite a bit about two in particular. One is the use of generative AI in interactions with customers. So we have done some work as financial firms have implemented chatbots. And when I say chatbots, I mean not live chat, but a chatbot. And what we find is that sometimes firms that deploy them in a sort of hasty way can incur a whole host of risks, including whether that chatbot is giving wrong information, whether that chatbot is ingesting very sensitive personal data that is then being shared or used for an algorithm. So I think as it relates to customer interactions and generative AI, everyone needs to be thinking about how that could be misused or undermine the customer experience. I think there's a lot of financial firms that are using voice authentication in order, as part of the funnel, for people to be able to get into their account or to be able to call and authenticate and speed up the time in the call center. The challenge with that is that for many of us, and it will be increasing for everyone, the more that your voice is in public domain, the easier it is going to be to clone. So all of the ways in which generative AI is also going to be vectors for fraud is something that I think is going to be high on the list as well. Now, of course, loan origination underwriting is really where much of the thinking is. I think, just to be direct, we don't hear it anymore, but I think early on there was some sense of, well, our technology is kind of cool, so we can't really actually explain what it does. And I think that just doesn't work. So the federal law requires that you give a notice that explains the reasons why someone received a denial or an adverse action. And if you can't say those reasons, then you really can't be using that vendor or that model for your loan origination. You also, and we actually issued guidance related to this, you can't use the sample reasons in the adverse action notice if they're not true. So I just encourage, as you all do due diligence, don't just think about this as a legal compliance matter. Think of it also as a customer interaction issue as well, about are you able to faithfully explain really how your own business practices and underwriting models are working. Now, I'm going to, of course, fair lending, people are actually quite accustomed to this. We do know that it's fairly mature about how many firms deal with this. So I'll share with you, last week, we ordered Citigroup to pay a pretty substantial penalty and redress because of a discrimination scheme targeting Armenian Americans. So essentially what would happen was, if someone with a last name that had the suffix of YAN or IAN, even if they would have otherwise been approved, Citi had a way to deny them and actually artificially gave false reasons as to why they denied them. Now that's actually human and a old school discrimination, but just think of it from an AI perspective. If your own algorithm is somehow knocking out people with that suffix, that could be a problem and could be an issue when it comes to prohibited national origin discrimination. So some of it, the more you have your model as explainable, I think the easier it's going to be for you to make sure that it's not creating fair lending compliance issues. Now, you asked, I think, about residential real estate. So it's part and parcel, especially, this is not just in law. There's the GSEs, others often require automated valuations that are developed by algorithms, AI. I think, Yana, we're just basically trying to make sure we, the FHFA and others, that those models have some gut checks and controls when it comes to fair lending and non-discrimination. And the issue is not undervaluation or overvaluation, it's just accuracy. And we want to make sure that in many ways when residential real estate is being appraised, I think there's always concerns when it's driven by a lot of individual homeowner characteristics. And we've all seen the stories of people who remove their photos from their fireplace mantle and then get a totally different valuation. So that's not just a human issue, that also that bias can be built into the machine.
I think that's really important. I know many of our members, we have one of our members, Upstart, leads the More Than Fair Coalition, and discussing a lot of these issues, AI and being able to explain that. We certainly see a lot of promise in AI, but certainly guardrails are, at least speaking for Yana, I do believe that those are necessary. And using AI to get away from the type of discouragement, because the Citigroup suit or consent order, that absolutely gives you that old time racism, right? That old time discrimination, and AI really is meant to be something that combats against these experiences that many people up to this day in 2023 experience as prospective small business lenders, small business borrowers. And owners and other consumers and folks in need experience, based upon what they have on or, what zip code they list. And, these are pieces that, we want to see. I know AFC members and many other members here want to see be eliminated and eliminated the right way. So we'll wanted to switch gears one last time, just speaking of small business. Know that the Bureau has, finalized its 1071 rulemaking, and there's a lot going on there, a lot of movements there. What else can you tell us in terms of what the Bureau's thoughts towards, navigating small business lending and navigating innovation there next year and beyond?
Yeah, so look, I think when we all reflect on how PPP went, I think there's a pretty good story to tell about how smaller firms, both, bank and fintech, really met a lot of the needs that we see there. So there's a lot happening. Obviously, the Small Business Administration has put forth, I don't know exactly where it is, but more small business lending companies that would be able to originate or guarantee SBA loans. Certainly, we see an environment right now where small business borrowers are still heavily using personal or consumer credit to finance much of their business needs. And the rate environment is one where you see so many small and mid-sized enterprises deferring certain capital expenditures and even dealing with difficulties on financing their working capital needs. So I think, obviously we want to make sure that just the concepts of open banking, and while our rules and orders, I don't believe would necessarily cover small business financing, the concepts are the same, is that we want the ability for small business owners who really have a good set of digital records to be able to permission that and be able to obtain financing in ways they might not otherwise be able to. So certainly we're thinking a lot about what can we do to contribute to that. We actually talk quite a bit to states and who are crafting their own laws and regulations on this. I will say, Yana, the place that we have also put some thinking into is how do franchises really navigate the small business lending market. So you may know that, for many, many people, a franchise is a big gateway for entrepreneurship and small business ownership. We know that they in particular have lots of different challenges that they face in financing. We also find that small businesses are also dealing with credit reporting issues. So there are a number of firms that assemble information about small businesses. They sell it to lenders, others. So I think a lot of the experience that consumers have, especially when it comes to sole proprietorships and very small businesses, they experience some of those same issues. So, again, we're a consumer regulator, but there's places where small business financing, will continue to occupy our thinking and resources.
A lot of exciting stuff coming up, a lot of work and a lot of dialogue, and we look forward to have our members and on behalf of AFC and our team and our members, we look forward to continuing that.
Really, thank you. And I think my push for all of you is, I think most of you are really, not all of you, but most of you are kind of in consumer finance. And part of the reason you like this business is that, yes, sure, you'll make money, but you also want to help people achieve something in their life. It's kind of why all of us are drawn to consumer banking. And so I think I want you all to really be thinking not just about, the next few quarters, what this regulation is, but how will you position yourself, and how do we want to create a market structure that is not just about the problems of today, but what really will people be experiencing in the future? What is the new ways in which people will be able to borrow, repay, the new ways people will make digital payments, the new ways that commerce will be promoted by the things that you do. So I hope that you'll consider, how you're looking at the future and how you're building businesses that are not built on data exploitation, are not built on digital dark patterns and manipulation, are not built on information asymmetries, are not built on regulatory loopholes, to ultimately create a very durable business model that I think is serving people well as your owners and shareholders.
That's so well said, and I think that speaks directly to what American Fintech Council, what we're getting at as a trade association. We don't run from regulations. We want sensible sensible regulations based upon data, based upon all the work that your team is already doing, and based upon, certainly the stakeholder input that we engage you all on. And those are extremely important tenets that you just listed that are extremely important to our members, and that's what makes this the trade that we are. We're at time, so I want to thank Director Chopra. Please give him a round of applause.